Hello, welcome back. In this video, we're going to define discontinued operations formally, and we're going to distinguish discontinued operations from restructuring charges. Now, going back to the Google example, now when Google sold Motorola the home in 2013 and the mobile business in 2014, remember we put something here right underneath everything that we are very close, very familiar with, which is called net income or losses from discontinued operations. Now, we're going to formally define what discontinued operations are. Sometimes a company decides to discontinue or sell part of its business. Discontinued operations are reported when a company of an entity or groups of the components have been sold, disposed of, or is considered held for sale. Now this one, even if you just get the news out that you want to sell your one of your sub-segments. Or you may be in talk with several bidders, but you haven't closed the deals yet. But as long as the news is out, you should put this segment under discontinued operations. So it doesn't have to be, closing the deal in order to be qualified for a discontinued operations. And two, the disposal represents a strategic shift that has or will have a major effect on the company's operations and financial results. Now, for the first item, a component of an entity that includes activities and cash flows that can be clearly distinguished operationally and even for the financial reporting purposes from the rest of the company. Like for example, Motorola's home or Motorola's mobile can be pretty easily distinguished from all the other Google services, right? From the web search business. So it's fairly easy to distinguish even for the operationally or financial purposes. So it qualifies for a component of the entity. Now, the second item, whether the disposal represents a strategic shift that requires the judgment of a company's management team. Examples of possible strategic shifts include the disposal of operations in a major geographical area, a major line of business, or a major equity method investment or other major parts of the company. Now, for example, Campbell Soup, they forgave their European market. Now, that is a strategic shift. Or Zoom recently announced that they will quit the Chinese market. That is also a strategic shift. Well, because they are doing the same business, it's just geographically different. So it's really hard to separate it. So it counts as a strategic shift. Although a company has considerably flexible in reporting, the income from continuing operations, right? We mentioned single or multiple step income statements. Now, for the discontinued operation, we are really strict on the format. It is actually mandated. You have to report as what these, the yellow box look like. So in the yellow box, you have to first have a line called income from continuing operations before income taxes. And then the income tax is 40%. So it's 40% times $1,000 equal $400. Now, the blue line is where we saw in Google, right? The income from continuing operations. That is a net of the 400 out of the 1,000 equals 600. Okay, so next we come with these discontinued operations. We call it income from discontinued operations. It is a gain of $100, but we also have to net of a 40% income taxes. 40% of 100 equals $40. So then we report 60, which is 100 minus 40. And then, we use the 600 from the blue, the continuing operations, plus the 60 from discontinued operations equals 660. Now, all else the same, investors should not expect next year's net income to be $660, right? Because only the $600 of profits from this year are gonna be part of the continuing operations. One more thing is that this one, the separate reporting, right, includes the taxes as well. The income tax expense associated with the continuing operations is the $400, and it is reported separately from the income taxes of the discontinued operations, the $40. Also, in the case that there is a loss from the discontinued operations, right now it's a gain of positive $100. If it is a loss, then there will be an income tax benefit instead of expense, because losses from discontinued operations are tax deductible and would reduce overall taxes owed. That's why it is a benefit. Now, let's make it more clear. So income tax expense, we're gonna assign it to each component of the income that causes it. There is this continuing operations, right? We're gonna show the standalone income tax expense. This part is gonna show as one line item. But for the discontinued one, we just report the effects of discontinued operations and extraordinary. So what we report under this discontinued operations is the net. So it already deduct the related income taxes. So if we see the Google one here, again, we look at this line, net income from discontinued operation. This positive 516 is already net of the tax caused by these discontinued operations. And this negative 427 is already plus the income tax benefits. So we don't see it here, but it will show up in the notes below about how much the tax rate is, and the original loss is how much. Now plus the benefit, it comes to 427. And how do we come up with 516? Same. Now let's do a quick example. You can pause here. So during the year, this company, Apex Co., sold an unprofitable component of the company. The component had a net loss of operations during the period of $150,000, and its asset sold is also at a loss of $100,000. So the total loss of this business is 150 plus 100, right? So it's 250. This is the loss, the total loss of this discontinued operations. Apex reported income from continuing operations. So the first line is 128,387. This is after taxes. Okay. All items are taxed at 30%. So how will this appear in the income statement? This is how it looks like. We started from this income from continuing operations, just like what Google did. And this is the amount net of the related income taxes expense. And then we have this discontinued operation, the second line. To break it down, we have a loss. This loss includes two things, include the loss of the business and also a loss on disposal. So in total, it's $250,000. Since it is a loss, we have an income tax benefit. Now this $75,000 is calculated using the 250 times 30%. So we paid less than we should. This 75% is the amount that we can reduce from paying the tax. So the loss on discontinued operation is the net, which is a negative 250 plus 75 equal negative $175,000. And then we also report the net, right? Finally, net income or net loss, which is this 128 and the sum of 128 and the 175, which is a negative number. So eventually, this is how a discontinued operations example. Now, restructuring charges. This is another concept, and you actually will see it quite often. This is actually very different from discontinued operations. Number one, note that these are not the same because discontinued operations involves the closure of an entire segment. So it's like a big business line. Business line is closed. But restructuring charges, it include closure of a factory. You are closing down a factory, or you relocate the facilities from Alabama to, say, Atlanta, or you are downsizing the workforce. These are also treated very different on the income statement. For discontinued operations, the one that we just covered, it is reported, as a separate item, right? It is reported below the net income on the continuing operations. But restructuring charges actually is included in the income from continuing operations. So one is within the big categories of continuing operations, but the other, the discontinued operation, is reported separately. Also, remember we say discontinued operations, even if you decide to hold for sale and you haven't sold it, you should report it separately. But restructuring charges are only recognized in the period when the costs are actually incurred. So there's also this timing difference. Timing. Now let's look at Macy's. You may have heard that Macy's have been closing their stores for the recent years. And we talk about, a closure of factory, right, is part of the restructuring charges. So you see in Macy's income statement, they have this line under the operating expense as restructuring, impairment, store closing, and other costs for the consecutive 3 years. Well, they must have started in 2016, 2015, but we just include 3 years in one income statement, and it is a negative one. So if it is a discontinued operation, it should be here, right? But it is not. Restructuring charges show up as an operating expense. Now, this is it for this video. And in the next video, we're gonna do some problem sets for discontinued operations. And then we will have a better understanding of how to recognize and how to calculate the discontinued operations net income or net loss. I will see you in the next video.